Good afternoon, everyone, and welcome to Beacon's first ever live webinar for the quarter ending on 3/31/18. This is Lynette Farina, Marketing Communications Associate for Beacon Wealth Management. Today's webinar is being recorded live, and the time is 3 p.m. Eastern Standard Time on Wednesday, April 18, 2018. The replay of this event will be made available on our website, www.bwmllc.com. our YouTube channel, and it will also be sent via email to our mailing list. If you would like to join our email distribution list, please either send an email to Lynette, Linette, @bwmllc.com, or visit our website and click subscribe to emails. Please remember this webinar is giving an opinion and is not blanket advice. Any performance numbers are historic, and you must put your personal situation in perspective and speak to an investment professional, ideally someone that knows you personally and understands your goals and objectives. The agenda for today's webinar is as follows. Quarterly update, first quarter 2018, Beacon portfolios, Beacon happenings, and Q&A from our audience. At this time, I would like to introduce CEO and founder of Beacon Wealth Management, Mark Germain.
Thanks, Lynette, and thank all of you to tuning in to our quarterly call. And really, most importantly, is the new format. Technology continues to shape everything we do and how we communicate. And today, we kick off the webinar approach to share with you graphical highlights as well as the information on what we look at each and every day. You often ask us, what is it we see that keeps us from changing or what actually suggests a change? So as you take a look at what we're doing on this webinar approach, we'd be very interested in your feedback, and you will be able to see the graphics exactly the way that we see them. So let's talk about the quarter in review. It was not at all a quiet quarter for the markets, and all of you were watching it and seeing what was going on. After the passage of the new tax law in late December, the stock market actually turned euphoric in January. It was a very big reduction in corporate tax rates from a high of 35% to now 20 to 21% is a clear benefit to U.S. corporations, allowing them to be more competitive against the international challenge. This change caused Wall Street's analyst community to substantially revise earnings projections, and they revised them higher. The low repatriation tax, that's where money's coming back into the U.S. that's been sitting overseas, potentially brings in cash and was viewed as a windfall, and it should allow corporations to spend on hiring and other corporate build-outs. Probably will also lead to more stock buybacks, which could, in this way, help boost the stock market prices. So, yes, the tax law can be a positive, and then there is the downside. And that downside is that the new tax law will substantially increase the U.S. budget deficit. This raises concerns about a flood of government borrowing. And this prospect actually increased bond yields in January. So the bond market was going down even as stocks were rising. February stocks actually peaked, and they had peaked on January 26th. And then we had a bout of very volatile days. And after month end, between the 26th and February 8th, literally 8 trading sessions, the market dropped a bit over 10% and then recovered. But remember, it was up almost 6% in the first 2 weeks of the year. But on February 6th, the fear index, which is the VIX, V-I-X, exploded as an ETF which speculates on volatility dropping actually was liquidated and lost tons of money for people. Big related spike in volatility when the XIB actually collapsed from that technical event. But it certainly woke up investors who were used to, since, literally for the last couple of years, a very, very calm market. A few days after the market low, the government issued an inflation number that actually surprised higher and added to the worries about rising interest rates. We've been telling you for months, the interest rates are not yet in the territory that we actually worry about them. So even though we're going to show you some statistics, it didn't strike any fear into the people that are doing the investing here at Beacon. So fears of protectionism wreaking havoc with the predictability of earnings growth was clearly something that when the president announced tariffs on steel and aluminum, the market generally believes these sorts of policies do tend to hurt the markets. And really it was the trade fears with a bout of weakness in the tech sector as government regulation seems very, very likely, triggered by Facebook's data leak. And as you see, Facebook dropped and now it's up 10, I don't know, 11% from where it dropped to. So March was a down month for stocks, but interest rates stabilized and actually seemed to even rally a bit. One area we first explained in our YouTube video in February is how volatility has been moving higher. We made an analogy of volatility to the up and down vibrations of a metal ruler at the end of the table, which you bend and release. The bigger the bend, the bigger the swings. Stock market volatility entered a new, higher volatility pattern this quarter after all of 2017. And people really started to fear that the volatility was actually the demise of the bull market, which we continue to tell people we didn't think that it was, and for a lot of reasons. One clear way to see how the market has changed is to look at the number of days the S&P moved more than 2% either up or down. So here is, actually we'll go back a slide. Okay, go to this slide. And we're going to get there. It's not there. So we have a slide, and it really shows how calm the market was in 2017. Literally, we didn't have plus or minus 2% days at all. And all of a sudden, in the first quarter of 2018, we see that we're now up to 5-6 days that actually had bigger than a plus or a minus 2% swing. So what does this daily change count? You know, when we look at it from a crisis perspective, as I told you, in 2017, there's nothing. It's worth noting that volatility is not the only thing that has changed recently. We're starting to see the end of what we would call financial repression. And the slide you're looking at right now coincides with a period of ultra low interest rates, so low that if you own cash, you couldn't even keep up with inflation. So have a look at the big changes we're seeing in the availability of short-term bonds earning a decent risk-free rate of return, something that was nearly impossible a few years ago when the money market bank deposits yielded, for all intents and purposes, nothing. Now the yield on Treasury bills are equivalent to the average dividend yield on stocks in the stock market. And if we look at this and we look at the S&P as the blue line, and we look at the green line, which is 3-month LIBOR rates, they actually are above the dividend yield on the S&P. Take a look at the pink line, U.S. generic government 3-month Treasury bill yield. Notice that it's rapidly approaching exactly what you can get in the stock market yield. For all of you who look at yield as the way to determine an investment, you can actually have a risk-free investment that is getting you almost the same yield as the stock market. So this elevation in short rates is changing investing perceptions. Situation experienced for years of earning nothing on cash helped create the perception that since you can't make money in cash, you might as well take a chance in other risky assets. For those of you who hate risk, then you certainly are seeing that interest rates are starting to climb and that there is the opportunity with very low risk in order to get the same yield. These are probably all things that you might want to start to consider, and in the very early days of what is being referred to as a regime change. More likely, we should be aware that risks are a bit elevated. And unemployment is at a cyclical low. Inflation is only barely creeping up to what the government has said is stimulative with their tax cut. So much that Wall Street's perception of earnings growth is actually the highest in 2 decades. And now, as Chris will be talking about, we see that the earnings reports are coming out exactly like we thought, and they're going up. But let's take a look at the change in the S&P annual earnings per share in the first 3 months of the year. This actually is from FactSet. Most strategists don't see evidence of recession coming this year, but we're concerned about next year when the stimulus has petered out and interest rates might be a little bit higher. As a matter of fact, if we listen to the Fed chair, there may be 3 more interest rate changes this year. Remember, the experts generally never see it coming before it's too late, especially the Federal Reserve. Sector returns, before going too far into kind of soothsaying, let's examine a bit what happened in the last quarter. The table, I think we have a table on we're taking a look at large cap U.S. stocks, and you see the year-to-date return through the end of the quarter, we were actually down. The stock 600 European stocks down 4%, small caps down almost flat, but they were still down. And the emerging market stocks were up 1.38. Treasuries, high-grade corporates were all down 1.5%. U.S. high-yield bonds were down, and the U.S. high-yield loans, what we call floating rates, were up 1.5%. It's interesting to look at this chart, and you can actually see what's happened to the returns. Everything in the bond world had a negative return, except sectors that benefit from rising interest rates. They being very short bonds or cash, or bonds whose payouts float higher or lower as interest rates change, hence the floaters. In stocks, we talked about European stocks. High quality bonds, we talked about them and where they're going down. And we do have the implication, if we show evidence that there's actually a regime change going on, the implication is very clear. Apart from cash, there were few places to hide in liquid markets last quarter. Returns in some non-securities markets like real estate or commodities, gold, oil, etc. And some hedge funds had more positive returns, as we experienced with some of our investments in the real estate sector here at Beacon. Drilling down a little bit further, it's not as if the highly volatile sectors of the economy were hurt during this quarter. Chart shows that it was some of the more defensive sectors like telecom and utilities that actually did the worst. And there were positive returns in consumer discretionary. Those are autos, appliances, apparel, rather cyclical, kind of economically sensitive sector, which is that consumer discretionary. Technology did well despite the worries over Facebook. In fact, FANG stocks produced 6.1% return in the first quarter, led by Amazon. So it looks as if this was not a classic sell-off where the conservative sectors did better. Where's the market stand now? April is the start of the first quarter earnings announcements. Earnings are rising sharply and expectations are quite high. The big fear the market has now are possible trade wars. The markets really don't like this idea because they feel it's zero sum, creates very, very unpredictable consequences. Who benefits from higher volatility? Traders, hedge funds, option writers, investment professionals, not you, the average investor who likes an even-keeled boat or has an objective that we're going for. It's not a trained sailor familiar with how to handle those kind of choppy seas, hence why you have Beacon managing that money. Fed seems intent on raising rates to what they consider a more normal level, and as we've told you in the past, that has a ways to go before we get there. Small rise in bankruptcies, but really it's not like there's a major credit crunch going on, so not to worry. The recession is not coming, and certainly the last 2 days made that pretty clear. Chris? Yeah.
Great. Thank you, Mark. We'll now have Managing Director of Wealth Management, Chris Cacchiola, give us an update on Beacon portfolio. Chris?
Thanks, Lynette. So, as Mark mentioned, markets have been extremely volatile to start the year. And from our standpoint, this is mainly due to all the cross currents we've seen develop in the first quarter, as U.S. tax cuts and fiscal stimulus, paired with increasing growth expectations in the first few weeks, pushed up stock valuations and bond yields very quickly. Then market volatility surged as policy risk began to pile on. including the Federal Reserve reaffirming their commitment to continue tightening throughout 2018. Add in the U.S. trade posturing, which Mark mentioned, and regulatory concerns around large tech companies and market leaders, or technology, the market leader over the last 12 months, you can see exactly why investors became fearful. While market risk has certainly shifted for our investors and shifted higher, as we mentioned on our last quarterly call, we believe the bull market does remain firmly in place. And it becomes important to take a step back and realize more so than ever, a good economy does not necessarily bring with it a good market going forward. So yes, economic data around the world has been stellar, but what's different in 2018 versus prior years is that now everyone really knows it, and it is priced into stocks. 2016 and 2017, we were advocates for global growth picking up, and the uptick in data we saw under the surface. And it presented great opportunities, in part because not many at the time believed it. 2018, in our opinion, is very different. Investor optimism, even after the correction in February, remains near all-time highs. The U.S. economy is running on all cylinders and continues to mature as the labor market tightens and wages increase. The effect that will have on corporate profits for us becomes one of the most important indicators heading into the summer for Beacon. From a macroeconomic standpoint, Beacon continues to favor the Eurozone and European area and emerging market countries, and you'll see that reflected in portfolios. In our opinion, their recovery remains behind the U.S., leaving room for upside in equities. Portfolios have exposure to Europe broadly and India on the emerging market side directly, and we continue to follow countries like Russia, which have been beaten up pretty badly to start the year. Next is the continued shift by almost all economies away from what we call monetary easing, which bears watching as it brings with it concerns for all investors, including ourselves, around market liquidity, as well as the potential for rates to rise further in 2018 than many expect. At the portfolio level, Beacon has been overweight what we call small cap stocks on the equity side for nearly 2 years now. And with the recent tax reform passed, we believe they stand to outperform in the current environment potentially. Most small cap stocks derive all of their earnings domestically here in the U.S., and with corporate America being one of the big winners in the tax bill, we believe this will be reflected over time in small cap stocks in 2018. Recent additions to the portfolio over the last 6 months have all had a common theme. They all have an inflationary component. Gold and silver and energy directly and through some of the miners are current overweights in Beacon portfolios, and we believe a maturing U.S. economy will bring with it higher inflation, and commodity assets historically have tended to be a good hedge against that inflationary pressure. On the bond side, we continue to favor high yield credit and mortgage-backed securities, bonds that are more tied to credit risk and the economy, and less sensitive to interest rates. We've been lowering our allocations to investment-grade bonds for over 6 months now and increased cash, but only on the bond side, not the equity side. Overall, all portfolios ended the quarter on sound footing, and when reviewing each component, we see that our overweighting in technology stocks led the way once again in the first quarter. Technology in 2017 was a leading sector, and to begin the year in 2018 has showed very little signs of slowing down outside of some of the volatility around Facebook in particular. The financial sector, one of our additional overweights in the portfolio, was our second best contributor as banks continue to benefit from a strengthening economy and rising rates. So all portfolios remain well positioned and nearly fully invested across both asset classes, and Beacon is positive on the overall trend of the market heading into the summer. However, the volatility in the first quarter is undeniable, and with the potential for more headwinds to develop, we expect it to be with us for the rest of 2018. More importantly, as we tell all of our clients, volatility creates opportunity, and we continue to believe that this is the case in the current market as the fundamentals we watch so closely tell us.
Great. Thank you, Chris. At this time, I'm going to go over and cover some Beacon happenings. First, please be sure to check out our website, www.bwmllc.com, as we've added some new features. We've added a page under the Resources tab called Videos. This page will include all of our uploaded videos from YouTube, Facebook Live, and the replays from our events. Additionally, also under the Resources tab, we have added a page called In the News. This page will include any media or press releases where we were mentioned or that have been published on our behalf. We have two popular upcoming events for you to schedule. First, on Wednesday, June 13th, we will be holding our annual Massachusetts, Connecticut Client Dinner in Connecticut at Cagino's Restaurant of Farmington. This event is held for our New England clients who may not get an opportunity to visit us here in New Jersey. Please join the Beacon team for an enjoyable dinner and for a Beacon portfolio update. For more information or to RSVP, you can reach out to me directly by phone, 201-447-9500, or via email, lynette@bwmllc.com. You can also visit our events page and register there as well. Secondly, on Thursday, July 12th, we are excited to announce our 6th annual invitational golf outing at Galloping Hill Golf Course in Kenilworth, New Jersey. We look forward to a fun day of golf with clients, centers of influence, and guests. Invites are going out by the end of the month via paperless post. For more information, to register or to request an invite, please reach out to me once again directly at 201-447-9500 or via email, Lynette, Linette, @bwmllc.com. Finally, we want to take this opportunity to have Mark answer a couple of questions from our audience. Mark?
Well, thanks, Lynette. And Chris, thanks for that update because it was really good. I think what is interesting is the question that came in and said, with the volatility, do I need to reduce the risk in my portfolio across the board? And Chris actually answered that question. He showed you IWM, which is the Russell 2000, and for months, we've had a trade set up so that if something gave us an indication that we should make the trade, we were going to make it in the client accounts. And he just said, we're probably thinking of holding on to that position. One, we've got some significant unrealized capital gains in it, no reason to sell it unless we really think we have to. So it continues to perform. And when people saw the volatility and we watched it, we would have thought, hey, we might be selling this, but in no way did we think it was something that we were going to do. We didn't hit the numbers that said it's time to sell it. So answer to the question in even better, in a little bit more detail, objective and timeline. Think about two very important things when you're investing. What is the objective you're investing for? If it's retirement and that's 20 years away, why are you worried about the volatility over a 2-week period? So what's most important, and when people call us, it's very, very important to constantly focus what we bring to you on the planning side, which is you need to have an objective. We need to know what the timeline is, and we need to know what risk tolerance. We wouldn't have you in a portfolio if you weren't able to tolerate that level of risk. If all of a sudden the risk level feeling changes, then we would change the entire portfolio. So answer to the question, no. You don't across the board make changes because there's volatility in the market. As Chris said at the very end of his talk, volatility increases the opportunities to make money. It doesn't reduce them. So all of you, thanks for tuning in to our very first webinar, and I'm going to turn it back over to Lynette Farina.
Thank you, Mark. Thanks, Chris. We definitely appreciate your commentary today. We want to thank everyone for tuning in to Beacon's first ever live webinar. We hope you enjoyed this Beacon event and found it informative. If you have any questions about today's broadcast or any questions at all, please feel free to call our office, 201-447-9500, and we look forward to our next live webinar for Q2 of 2018. Hope you all have a great day.
There's one question.
Well, there is a new question?
questions? Sorry, okay, there was, and then it went away. So
Okay.
somebody
Okay,
maybe-
everyone,
okay,
thank
yeah.
you.
Okay, great, thank you.